And this is where I want to get your sense. Is the roll down in inflation expectations sufficient for Lagarde and Powell to justify and stand up a really strong pause narrative? Good morning.
Good morning. And yeah, I think it is. I think when you look at what both Jerome Powell and Christine Lagarde have been saying, they're going to be looking at the data. And the data yesterday from the growth standpoint was obviously disappointing for them. And they will see that the inflation is likely to continue to roll down throughout the later stages of this year and into next year. So they've done a lot. They've hiked an awful amount, as we know, and at such a rapid pace. And they're going to sit back, I believe, and say, we know there's going to be lagged impacts. We don't quite know exactly what those lagged impacts are going to be, how long they're going to take. So it makes sense for us to take a pause here, reassess, and then see over the coming months what the implications are for everything that we've done so far.
Well, Ed Udani believes that the bond vigilantes are saddling up and have been reawakened. The data, however, may reduce that argument. Has the last train to jump on board solid duration left the station?
Yeah, it did feel a very unloved market for fixed income investors over the last few weeks or so. But we've been saying for a while that the lagged impacts were likely to be coming through. And it feels to me that we've got, for those people that had missed the bond rally earlier in the year and felt that they hadn't managed to get in, it just feels like another opportunity to come back into bond markets. Because we know that once you get to the peak in terminal rates from the Federal Reserve, from the European Central Bank, bonds typically do very well after that. If you look over history, over the last 7 Fed hiking cycles, post the final hike, bonds do very well, significantly outperforming cash. So it does feel like we've had a little bit of reprieve. People who did miss the bond market rally earlier this year, they've got that chance to get back in.
The debate, and I like the fact that you bring up, I mean, I am not a mathematician and I do not have a PhD, and I'm not going to even attempt to define what the R star rate is. But yourself and Bill Dudley are better qualified than I am. And it's interesting that he says, get ready for higher rates. He has a view that, and this is his math, by the way, which is that the R star, the neutral rate will be 1%. The average term for the average long-term inflation, 2.5%. Term premium, 1%, gives me a total of 4.5%. The R star neutral rate, now I don't have a PhD, right? I think that's very low at 1%. What do you say?
I think this is an environment where we don't know, and I think that's what Jerome Powell is going to say tomorrow. I think he's going to play a fairly straight bat, and he's going to be saying that actually we just don't know. He said that over the last few months or so, and the reality is the Federal Reserve and other central banks around the world believe they are now in restrictive territory. They now think they've taken rates high enough, and even if the numbers that we're looking at there at 4.5%, we're still above that now. So it feels like we're in the right stages for the central bankers to pause, take stock of what's happened, and reassess. And I think if I was Jerome Powell, I would be saying that we're data dependent. We know we've had the weaker data over the last couple of days. There's a couple more important data prints, both inflation and jobs reports, before the next Fed meeting. So we'll look at those. And he's not going to predict what's going to be happening, because ultimately he could be wrong in the next few weeks or so. So I think he's going to say we're going to keep an eye on the data, and that is exactly what he has been saying.